The Indian rupee has declined below 87 to a dollar. You may have heard market experts and economists talking about the possibility of the rupee falling to 90 or below. So why has this happened? What explains the decline? In this video, we will try to understand what's going on with the rupee and also what potentially lies ahead for our currency. But before we come to that, just remember that this video is for information purposes only. It's not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. Now, historically, a declining rupee would not surprise anyone. We Indians have always expected the currency to fall between, say, 5 to 10% to the dollar nearly every year. In fact, we would be surprised if the rupee appreciated. However, over the last few years, things have changed. Ever since the rupee fell to nearly 83 to a dollar back in October 2022, the currency has remained stable. In fact, the rupee has been one of the strongest emerging market currencies over the last 2 years. This is because a tight trading range between 82 and 84 to a dollar mostly held. An article in the Mint has pointed out that the rupee's decline from 82 to 83 took 10 months and the decline from 83 to 84 took 14 months. However, since September 2024, the rupee has got back to its old ways. The decline from 84 to 85 took only 2 months, and as you may be aware, the decline after that has been even faster. At the time of recording of this video, the USD INR is trading at 87.6, an all-time low. So what explains this decline? First, the non-reasons. Let's examine the factors that are not the reasons for the decline in the rupee. One important thing to understand here is that there is nothing fundamentally wrong with the rupee. Despite the recent record high trade deficit that we have seen, India's overall current account deficit is well under control at 1.2% of GDP in the second quarter of FY25. Of course, this data is reported with a lag, and the data for the upcoming quarters could show slightly higher percentages. But it's unlikely to be of much concern. And it's certainly not the case that the Indian consumer is spending so much that our imports are getting out of hand. That is just not the case, with the exception of a spike in gold imports during the festive season last year. But that was seasonal in nature. The recent union budget has also reaffirmed the government's commitment to disciplined spending. The fiscal deficit has been brought under control after a massive spending done during COVID times. In this financial year, the fiscal deficit will be around 4.8% of GDP. This is down from 9.1% back in FY21, a commendable achievement. The deficit for the upcoming financial year has been projected to be even lower at 4.4% of GDP. Thus, there isn't much pressure on the rupee due to either the current account or the central government spending. Also, crude oil prices, which have a big impact on the rupee, has been stable. There has been no rise in global price of crude oil over the past 1 year. Inflation has also moderated somewhat recently, especially core inflation, excluding certain food prices. The CPI was 5.2% in December 2024. Now that we have seen the reasons that have not caused the rupee to fall, let's talk about the main reason for the rupee's decline: the strengthening dollar. The correct way to understand the weakness in the rupee is to understand the strength in the dollar. Look at this chart of the US dollar index. In about 3.5 months between the end of September 2024 and mid-Jan 2025, the dollar index has strengthened by about 10%. In fact, the dollar is now close to its 2022 peak, which in turn was the strongest it has been going back more than 2 decades. This strengthening has happened against most currencies, including the rupee. So why is the dollar so strong? Well, the reason is the strength of the US economy itself. Now, the US economy may not be growing fast at just about 2% per year, but it has been the best performer among developed nations. Also, the US economy has experienced what is known as a soft landing. What does that mean? Well, the US central bank, that is the US Fed, has managed to raise interest rates just enough to bring inflation in the US mostly under control and at the same time not triggering a recession. This has resulted in high confidence among global investors that the US economy will remain strong in the future as well. This in turn has resulted in many billions of dollars flooding into the US economy over the last 1 year or so. A part of that money has flown out of the Indian stock market too. FIIs have been selling Indian stocks relentlessly since September 2024. This has left the US dollar as the biggest winner among global currencies. The Trump factor. Last time Trump was US president, the US dollar was stable and the US economy performed quite well, at least until COVID hit in 2020. The financial markets are expecting a repeat from Trump 2.0. Global fund managers believe that the US economic growth will pick up further under Trump's second term as president, which in turn will attract even more funds to the US. This flood of money will cause the US dollar to be stronger for longer. At least the stronger for longer narrative is what is going on right now. As long as this narrative in the global financial markets remains intact, there is no way to fight against it. The fund flows into the US are just too strong at the moment. However, this is not something that is cast in stone. It remains to be seen how much exactly the US economy actually grows under Trump. Also, if this growth results in higher inflation in the US, then it won't be positive for the dollar. And then there is the uncertain factor of tariffs that Trump could impose on any number of countries, as he has already done against China. The direct and indirect effects of this policy on the dollar will only be known over the course of 2025. Limited rate cuts. The US Fed was expected to cut rates after bringing inflation under control. While it has begun this process, the latest commentary by the US Central Bank has not been generous in this regard. The Fed has said it will cut rates only twice in 2025. This was against the expectation of 4 cuts earlier by financial markets. Lower interest rates reduce the incentive for large investors and fund managers to park their extra cash in US bonds. This results in a weaker dollar. However, if interest rates are not going to be cut as much as was being expected, then the result will be a stronger dollar. That is what is happening right now. And this will result in a weaker rupee, which is what we have seen recently. Conclusion. A weak rupee has negative consequences for the Indian economy. The biggest concern is called imported inflation. India is a net importing country. This means we import more than we export. As the US dollar is the world's reserve currency, it is also the world's main invoicing currency for goods and services. If the US dollar gets stronger, that is the rupee gets weaker, the cost of all our imports goes up. This will be the case even if the volume and the international price of imports remains the same. For example, as a country, we just can't reduce our consumption of crude oil. So even if the price of crude oil stays constant in the international market and India imports the same amount of crude oil, the cost of petrol and diesel will still go up if the rupee falls against the dollar. Investors in the stock market will need to be aware of all this and more. There will be winners and losers in the Indian economy due to the depreciating rupee in the short term. However, in the long term, the underlying fundamentals of the companies will be the deciding factor of stock market returns. Thus, if you are a long-term investor who has picked fundamentally strong stocks at reasonable valuations, you don't have much to worry about. Happy investing.